Luna was blowing up. Three Arrows followed, then FTX.
By the end of the year, yeah.
FTX estate wind down was handled by Galaxy, so we got a front row seat for that. There's $1 billion of notional daily volume on the Kalshi perp now. Decide whether you think that's real volume or not. The horse is out of the barn at this point.
Wasn't there like a funny story that came out like sometime earlier this year about someone in France?
He figured out that it was a temperature reading at the airport, I believe, and he was out there with a hairdryer, on the thermometer, right? Well, he got arrested.
This is here to stay. It's a truly new commodity and we all need it.
I don't know if I want to go that far. I think it has more potential than broadband.
Welcome to another episode of Derivatives Decoded. Today, I'm honored to have Mike Harvey on the podcast to share with us, honestly, a lot of views on a lot of different things. We got a lot to talk about today. But before I do so, I'd love for you to, take the chance and introduce yourself to everyone that's listening to this podcast.
Thanks, Ash. Yeah, so Mike Harvey. I currently run franchise trading at Galaxy. I've been there just under 3 years. It'll be 3 years in October. Coming up on 5.5 years in crypto.
Mm-hmm.
Before that, I spent about 18 years in TradFi. Most of that was at UBS, where I ran one of the FX derivatives books, as well as being part of the FX derivatives management there. And I also had a brief stint trading precious metals options. It's at one point in my career. I spent 1.5 years at a crypto firm called JST, running most of their day-to-day and officially as head of trading there. And then I've been at Galaxy since late 2023. So I've seen a lot of things in those nearly 3 years. And I often get asked, what does the franchise part of franchise trading mean? And for us, that is everything outwardly focused. So everything client related. And that covers our electronic spot business, our high touch spot business, and derivatives primarily.
Beautiful. I guess you've been in digital assets / crypto for what now, like 6, 7, 8 years?
5.5 years, yeah.
5 years. Okay, beautiful. So obviously you've seen a lot, both seats, right? At JST.
I signed my contract to start at JST the week that Luna was blowing up.
And then
Three Arrows followed, then FTX.
By the end of the year, yeah.
And then I had, obviously, FTX estate wind down was handled by Galaxy, so we got a front row seat for that. But I've seen a lot of things, right? And now we're moving into a different period post-Genius, potentially with clarity on the horizon. The next sort of 2-3 weeks are very big for clarity. We can touch on that a little bit later, I think, as we talk about where digital assets in general goes from here.
We absolutely will. I think this year, there's a lot of regulatory sort of changes that are happening, right? And being someone that has obviously been head of trading, running a franchise trading business today, right? All that stuff is very, very relevant to, I'm guessing, your day-to-day now. So I want to start by talking a little bit more about your views on the CFTC guidance, allowing access to perpetuals, options, to both Coinbase and Kalshi, right, starting off. And what do you think that means? Like, where does that take us? And I know it's like a big topic because
it's a very fraught topic, I think. So late May, the CFTC came out and they essentially made a snap decision that said Kalshi's Bitcoin perp is approved.
Yeah.
And it's a future. Therefore, CFTC has the regulatory purview. The interesting thing about that was that under the previous administration, the CFTC had come out 4 or 5 times saying perps aren't futures, they're swaps. There's a lot of things about the product that you could throw in the swap bucket. Now, I think against the backdrop of a administration that is much more crypto friendly, this ruling was a crypto friendly ruling in the sense that perps are, certainly from an institutional seat, a great product.
Yeah.
Right. It's very clear how they function. They provide institutions with an element of leverage, right? And leverage is one of the points of the CME's case against the CFTC, which I'll come to in a minute. But it's a great product, and it is certainly very crypto friendly of the CFTC to go ahead and say that U.S. regulated firms can offer them, right? There's several facets here. One, and I think this is probably, if you want to think about it from the American innovation competitiveness standpoint, I think it's something that should have been done and was done properly, in the sense that if you go ahead and say that you can't have onshore perps, then you're essentially forcing market participants to operate completely offshore, which is not going to be great for American trading firms.
Yeah.
Right. Or it's going to force American trading firms to have offshore entities and complex entity structures, which is, it's fine. But, the other piece of it is retail access, right? So if you want perps available to US retail, classifying as futures makes that a little bit easier. There's a higher margin bar for swaps, and swaps are only eligible contract participants.
Yeah.
So I think it was a crypto-friendly judgment. Now, the key thing about it is two things, right? One, it's not codified in law, so it could be walked back by a future CFTC administration. It's also being challenged in court now by the CME, right? Now, why is the CME doing it? And, I'll speak freely because why not? Again, these are my views, not the views of Galaxy.
Of course.
It's a turf war right now because the CFTC, the CME does all things futures, and futures by definition have an expiry date, whereas perps do not. And because these are better products in general, and because retail is able to trade them, the volumes are going to migrate to perps and away from things like the CME's dated future, away from the CME's 5-year expiry perp product that no one trades, right? So this is a turf war. I think, unfortunately, the CME has a leg to stand on in the sense that, there are definitional issues here, right? Looks like a swap, talks like a swap.
Then it is a swap.
Right. But, but also I think there are also things in favor of it being classed as a future. I think if and when this comes to be litigated in front of a judge, the procedural flip on the part of the CFTC is going to be a problem. They're going to say, hey, you went after BitMEX, you went after Binance, you called these things not futures over the previous 4 years.
Yeah. Why you're letting...
And now you're saying it's a future. So,
Yeah.
Look, I think if it stands, if it can somehow get codified into law under clarity as a digital asset derivative, and the CFTC has clear purview over it, then they're free to now, under the aegis of the law, say this is a future. So, in a way it hinges on clarity, but also, it could be walked back. And, there's $1 billion of notional daily volume on the Kalshi perp now. Decide whether you think that's real volume or not. But, nonetheless, the horse is out of the barn at this point. So it'll be interesting to see if it has to be walked back.
Okay. So, does that also, I guess that story plays out, and, we also see the CFTC denying like the CME's oil, 24/7 future.
24/7 is
right?
different. I'm not as...
But do we think that's like is that actual grounds or just like kind of a response to deciding to sue the CFTC?
No, I'm not as well read on that point,
Yeah.
but what I know and the conversations that I've had is that, literally the entire TradFi apparatus just isn't ready.
Yeah.
Right. They're not ready for nights and weekends margin calls. They don't have the infrastructure to support it. Certainly you can't send a wire at 1 a.m.
They have maintenance windows as well, like this whole active situation.
The
tech is just not
these tech stacks and
Yeah.
the whole financial infrastructure hasn't caught up to 24/7 the way it is in crypto. So, is there an argument to be made that it should catch up, and it will? Like, certainly, right? If you can send in USDC at 2 a.m, then yeah, right. But I think the 24/7 thing is more industry participants coming to the CFTC and just saying, whoa, we're not ready.
Yeah.
I think that's where that lands for the moment, at least. The interesting backdrop to that is what's going on with Hyperliquid. They're certainly turning on the lobbying machine. In certain verticals, they have a point, right? Like, they have a very compelling product market fit for nights and weekends trading of whether it's equity perps or commodity perps. Those are products that people use. People have come to us and asked us about their ability to trade those in some form or another. So I think for now, we're going to live in this bimodal world where you have DeFi or crypto native exchanges offering 24/7 liquidity in commodities and TradFi, assets, whether it's index or single name. And we don't yet have the regulatory clarity on, what do you call an equity perp, right? Certainly doesn't sound like that's going to be a future. It sounds like that fits in like a securities-based swap.
But it is
area.
listed already, right? Like, I think on some of the centralized venues that are regulated here in the US, like Coinbase does offer equity perpetuals.
Yeah, there's just there's no regulatory clarity on that, and I don't think V1 of clarity is going to cover that.
Actually,
that is very much, choose your own adventure at this point.
So scenario A, the CME loses this whole litigation sort of path, and
they're no worse off.
Okay, but then your thought process is that eats into their own liquidity to some extent, right? As retail, gets access to these essentially these instruments that otherwise they don't really have a direct path
Yeah.
to.
Now I have no actual like view into what they're thinking. Obviously,
Mhm.
if it were me, I think the CME would just list the perp.
Yeah,
You know.
to fight back, right?
Yeah. I mean, that would put them on equal footing with the other CFTC regulated perps in terms of it's got to go through DCO, DCM, it's got to be listed on an exchange. It then falls to the FCMs to decide the proper margin treatment for them, along with the CME. But I don't think the CME is necessarily worse off if the CFTC prevails here. I think they'll just have to bring some newer products to market to give the end participant what they want.
So what happens if they win? What do you think that means for effectively the two first venues, right? Like are really driving that kind of guidance, right? Like both Kalshi and Coinbase.
Yeah,
are.
I mean,
So
then you just rewind to where we were 6 to 12 months ago, and Binance has market share, offshore Bybit, OKX have market share. Coinbase is fine because Deribit still has their market share, right? So
yeah, but the path to touch
yeah,
that just now is
yeah.
blocked,
Well,
right?
I mean,
So
it's really a retail thing. It blocks U.S. retail.
okay,
I think institutions have it figured out.
which is the more likely scenario, you think?
I have no idea. I mean, again, my read is that depending honestly, like this is a question that goes to somebody who watches the tendencies of whichever judge this lands in front of, right? If it's a crypto friendly judge, it probably goes in one direction. If it's not, we'll see.
So how does Galaxy is attempting to position itself with this convergence of everything over everything? Like I know you guys are involved in prediction markets and compute and derivatives and
Okay.
in AI.
I mean,
Across the board.
let's try to hit those,
Yeah.
one by one. So,
Okay.
let's first hit on prediction markets. We've announced it. We've put out plenty of research pieces as well. We started an OTC predictions offer. I think the best way to understand that, and hopefully this lands with people, is to think of how traditional finance, like exotic options desks work. They give the clients a bespoke payout, one that can't be traded via listed instruments, for example, or standard calls and puts. They give them that bespoke payout. They then go figure out a way to manufacture the exposure, and they necessarily have basis risk between their hedge and the exposure they've given the client. And we view prediction markets through a similar light, in the sense that, where I think the true institutional volumes will start is with things where people can put that basis hedge on in some respect. And that's very much the way we're pursuing it, is essentially give the client the event exposure they want, and we'll go hedge, via what we think the financial markets outcome will be based on that event. And it's law of large numbers. If we do lots of trades that way, you may have an event outcome, where you didn't get it right,
Yeah.
and it'll cost you money. But over the long term, if you do the hedging correctly, if you have the right read on event versus outcome, you arrive at the right place. And so that's the business model. I think the important thing to understand about our offering is we're not just doing execution on Kalshi for people or execution on Polymarket. We're providing an OTC essentially lookalike, in the sense that we leverage the venue's oracle. So we want nothing to do with being an oracle or trying to decide the outcome of the event. We say, you want exposure to this Kalshi contract? Here it is in OTC format,
Mm-hmm.
and you face Galaxy directly, and the outcome gets decided by Kalshi in that scenario. And
So not the pure agency model, right? You actually are trying to build an OTC business on top of what is effectively a new asset class, right?
we were very public about a large trade that we did. You can go look it up.
Mm-hmm.
I don't want to name names, in this context, but we were very public about this trade, where we did a $10 million trade.
Yes.
And life to date, there had only been about $2.5 or $3 million of notional on that listed market.
Yeah.
So that's the business model, right? These are largely retail-led markets right now. The sizes are tiny by institutional standards. We bring the balance sheet and the ability to take that principal risk, write people the event exposure they want at institutional size, and then we go away, and ideally we're using other financial market instruments to hedge that basis risk.
Have you defined your policy at Galaxy on how you want to approach that market, given the fact that there's just a lot of controversy on what's available on these markets? Like if someone shows up and they're like, give me a market on the death of X.
Oh yeah, absolutely.
Right?
So just just to be very clear,
Yeah.
And there's always going to be maybe a gray area where we have to have discussions internally. Is this something we want to to make a market on, but we're
Yeah.
very clear about no sports and no death.
Got it.
So like, you know, that like,
Which I think makes, I mean, that's a very reasonable
yeah, I
thing
mean,
to do.
yeah,
right?
like, you know, look, we're not
So-
gonna, we're just not gonna be.
You're
in
not
the
going to allow
business-
people to bet on someone's
yeah, you know,
time,
and
so-
death is very loosely
Yeah.
described, but you know, like regime change, just not going to go there.
Yeah.
Right. But, you know, certainly outcomes of elections, something we think we can construct a hedge for. Very certainly, you know, whether it's crypto related outcomes, you know, will Bitcoin be above 100K over the next 6 months? Like we can almost perfectly hedge that outcome. So
Yeah.
we'll be happy to write event contract exposure to that. So yeah, no sports, no death, nothing, you know, nothing that's even has any hair on it, I would say.
Which I mean, I think it makes a lot of sense. And I think honestly, everyone is probably going to be following suit, right? Like including the markets themselves, right? I mean, there's already a lot of back and forth on did these death contracts even make sense at all to be
I mean,
listed on
there's-
screen.
So there's an interesting anecdote that I heard, you know, so the guy who runs prediction markets for us works for me, and we've worked quite closely in setting up the business. And so I get to hear a lot of the goings on, and I'm on a lot of the calls. And
Yeah.
he got off a call with one of the two venues recently, and I can't remember which one it was, but there certainly has been some institutional interest in things like hurricanes, for example,
Okay.
right? Like you can come up with a good reason why an insurance company might want to hedge their exposure to a category 5 hitting some part of the Florida coast. Now they being the venue thinks that that's got some very real traction in the institutional space. And, you know, I tend to agree. You know, again,
that specific venue, that's their view that they're getting
yes,
a lot of traction
just that, you know,
within
that's
the institutional side.
that's
of
something,
things.
you know, there's
Yeah.
weather derivatives out there, there's cat bonds, but
Yeah.
I think there's, you know, again, like those are imperfect hedges. This is why contract event markets are so interesting to people, is you can hedge the exact thing you're concerned with.
I mean, they're very simple to understand as well, and just kind
Yeah,
of
of course.
you know,
They're, you know,
straightforward. Yes
yeah.
or no on a given. I mean, the resolution though, I think that's still also a question mark. And I've seen.
Yeah, well, let's finish off that example, then we can talk
Yeah.
about resolution a little bit. So, anyways, they feel like there's a lot of traction there. But they said they're very clear in terms of which sort of, call it, natural disaster contracts they will entertain. So, for example, wildfires they won't,
And what's the reasoning?
because you can go off into the hills and
And
start a
so on.
wildfire.
Okay.
So I think it's, you know, so there is real thought being put into the contracts that are listed at this point,
Yeah.
because they're aiming at an institutional audience. So, you know, I thought that was a reasonable anecdote where even, you know, the platforms who are incentivized to list as many contracts and get as much volume as possible are being thoughtful about what they do and do not list.
Wasn't there like a funny story that came out like sometime earlier this year about someone in France that
Yes.
was like doing this whole
He figured out that
like
the
hair dryer.
he figured out that you know, it was a temperature reading at the airport, I
Yeah.
believe, and he was out there with a hair dryer, you know, on the thermometer, right? Like,
get up right before.
well,
Yeah.
he got arrested. So
Yeah, true, true.
But I think that
Yeah.
you know, as more and more institutional money hinges on the outcome of these contracts, they're going to have to be smarter and smarter about how they
Yes.
design them, and that brings us to resolution. Now, resolution, I think on some level we've taken the view that the venue and people tasked with this at a venue is the best scenario, right? I think the method of essentially the venue delegating that responsibility to some decentralized organization is less good, because it's then unclear what the motivations of that decentralized organization are.
Got it.
Right. So if you're at the venue and you're primarily aligned with that venue's, you know, relevance and propriety, you're going to make the right call. Whereas if it's an unnamed mass of decentralized people voting with their share of some token, they could also be the ones in the order book who are very incentivized to vote a certain way. And so that's, you know, our view is that the incentives are aligned for the stewards of the outcome at the venue itself to be the ones making that call, right? And in a lot of these cases, it's very easy to make that call, right? Who won last night's baseball game? Well, that's easy, right?
Yeah.
You know, there has been some things in the news, you know, most notably the did sell or sell any Bitcoin market, where the naming of the contract and the rules were not clear.
Yes.
And the venue had to come out sort of after the fact and make a ruling, and people are up in arms about it. And, you know, my response to that is, I don't necessarily agree with the way they resolved the contract, but I think it's very unlikely that they are going to do anything about it.
It's a bigger problem for the venue than for an OTC business that probably is negotiating at most times, right? Like kind of
Yeah,
resolution
well,
with your
but
own
so
counterparties.
let's follow that idea.
Hmm.
If we had exposure to that contract, and we didn't, if we had, well, I should say we had no exposure to clients
Yeah.
that referenced that contract. If we had, we would have had to resolve it with the venue.
Yeah.
Like that's just the way that we've written our contracts. Now, the reason I don't think they'll relitigate that, or well, they may have to litigate it, but the reason I don't think that they'll overturn their decision was because the way the platforms work is that the losers pay the winners and the winners can take their money. And so it's very unlikely that the platform will be able to claw that back from the winners.
True.
What was next after prediction markets on your list? It was prediction. It was
we were going to talk a little bit more about just quickly touch on compute markets being like the new thing, and then just Galaxy's view on honestly the convergence of everything.
Okay.
I know you guys are involved.
So we'll hit compute and then we'll hit convergence of everything.
Yeah.
Compute is super interesting. As some backstory, right? Obviously, Galaxy has the Helios campus. We're half an AI company and half a crypto markets company.
Yeah.
And so we've had a front row seat to a lot of the development in the AI markets. And as much as we're very invested in AI and building out that infrastructure, it's been unclear to us what the financialized outcomes are going to be. But I do think, what I was skeptical at first for the following reason. A lot of the contractual trades as it is that were happening or have happened over the last 2 or 3 years are bespoke and bilateral, right? So you've got a neo cloud contracting with a hyperscaler on a so-called take or pay contract that could last from 3 to 5 years.
Yeah.
That neo cloud turns around and becomes a tenant to a powered shell where they install their chips and manage the cluster and run training and inference for their end client, right? And there's not a lot of room in there for the need to hedge, but that's also a very clunky apparatus where it's slow moving, it's bespoke, it's bilateral. And so I was initially skeptical because of so much of business was getting done in that manner. And what I've learned in the past, call it 6 weeks, is that there are parties involved in this ecosystem of transactions that are trying to bring a level of financialization to it such that hedging with listed instruments and some type of options market is actually more relevant and makes these transactions easier to finance. If you're going to go get financing for something, then demonstrating to the people that are giving you money that you have hedges in place becomes important. So I do think, without going into a lot of details, I do think there's something there. A lot of people have drawn the analogy to the broadband markets of the early 2000s and said this is going to be a thing that goes away.
Yeah.
I think it's a little bit more than that at this point because there's so much AI CapEx pouring into just developing the infrastructure to run these models that some level of financialization is probably an efficiency gain.
But is it even feasible to build a market on top of this? Like assuming we're both agreeing that, yes, this is not something that's just a fad and just going to go away. This is here to stay. It's a truly new commodity, and we all need it. And we need a market.
Yeah,
for
I mean,
it.
I
Is
don't
it even doable.
I don't know if I want to go that far. I
Yeah.
think it has more potential than broadband.
Okay.
I think right now there's a little bit of I'll call it a circularity in the index construction that's meant to underlie the futures that are going to list.
Okay.
Those indexes are constructed via hundreds or even thousands of individual trades or individual physical deals that are happening.
Yeah.
And the observability of those deals is not good, right? So the people that are striking those deals in a lot of cases are the same people that are producing the indices.
Yes.
And so there's not a lot of outside observability into whether these indices are, I'm not going to go so far as to say they're not legit. It's just like, one thing that makes financial markets function well is a good amount of observability in terms
And
of
index providers being to some extent independent of
yes,
the actual
exactly,
spot,
right? So
like
trading
that's happening. So
I'm going to steal another. One of the nice things about being in my seat is I got a lot of smart people surrounding me.
Yeah.
And so I get to hear a lot of really good takes on things going on in crypto and in AI markets. And somebody drew the comparison to LIBOR.
To what? I'm sorry.
LIBOR.
Okay.
Right, where this is again dating myself a little bit. I've been around for 25 years in markets, but the thing with LIBOR was the way it was set. It wasn't a traded instrument. It was observed, and the way it was observed was, I'll get this wrong, but whoever produced LIBOR would go around and call a bunch of banks and be like, what's your rate?
Yeah.
And some guy at the bank would be like, well, it's 2.25. The guy at the next bank would be like, oh, it's 2.4. And they would take 16, I think, and throw out the top 4 and the bottom 4 and average the middle 8. And that was how LIBOR got produced. I'm going to get that wrong. We'll have to edit that piece out. But
Sure.
It's something like that, right?
Yeah.
And so the parallel is that you had trillions of dollars of swaps and other products that were indexed to a rate that was set by a bunch of guys answering a phone call or an email. And, there's obviously problems with that setup, right? So the markets after 2008 and after some of the scandals that developed around LIBOR moved to using SOFR, which is a traded, observed rate. Right.
Yes.
And I think that's a viable parallel for the early nascent stages of this compute markets, is that you probably want more observability around these deals that are getting struck, that are going to feed into these indexes, I should say, that are then going to underlie these futures products. Look, I think the scale of AI and compute markets, and when I say scale, I just mean the CapEx numbers, right? Running into the high hundreds of billions of dollars. It's going to necessitate some element of financialization.
I think I agree, but I think it's a much, much harder problem than people want to, admit that it is, to kind of create a financial instrument on top of something like this, because the term compute is just like, within the age of AI, the stack is insane, right? How do you get a forward curve working on, for example, I mean, when you look at tokens, right, and like token consumption, like how do you build a fungible model of this AI lab versus a hyperscaler looking at their token? Like, it's just a weird way of trying to standardize something that is, by definition, today, it's just not a standard thing.
Yeah. Look, I don't disagree. I think there's a lot that needs to be done. And, my take is that if you want to come to it from the perspective of where's the money to be made in trading today, I think it's in the physical sort of, matching buyers and sellers of actual delivered, physical compute.
Yes.
I think that's where the market is today.
Mm-hmm.
And I think that has to grow up considerably from where it is to then merit putting derivatives and futures on top of it.
Are you guys today in a position where you will make a market on compute, or no? If I were to ask you to give me an option on, B200s for the next,
no, we're not quite there, but we are, we're running at it. We're doing our diligence.
Okay.
Right. We're a few steps up the food chain from being in a position to participate in this physical market that I described.
Okay.
Right. So I think we're, as I said, we're doing our diligence. When and if there is or are trades to do, we will be there. Certainly we have a history of being involved in Bitcoin mining and underwriting ASICs, for example. So, I think trades like that are where we'll probably play first. But I just don't know. We're early stages, but we're certainly involved from a diligence perspective.
As the head of franchise trading, right? And you guys are trading basically everything under the sun. And now all the venues that you were touching for specific markets are all going to be offering every other market that you were going to another market to touch on. So what does that mean for you? I guess like this whole, because I don't want to, so crypto is probably going to be behind now in terms of how people see it as an individual slither of financial activity. Right? Everything is just becoming the same thing.
My view on convergence in general is that you will have Bitcoin.
Okay.
You will have public blockchains that are already running and very decentralized. Like those things won't go away. You'll have some of these public-private partnerships like Canton. There's a few others. I think those will persist. And if you're asking me about what the future of crypto looks like, I think people in 5 years or 10 years won't talk about crypto and TradFi anymore. It'll just be finance again.
Yeah, I agree.
I think what we've seen is crypto would take off, and it would be, very front of mind for people, and traditional financial firms and participants would look at it and think I need to be involved in some manner, and they would start forming working groups and plans to be involved, and then Bitcoin would roll over and they would say, okay, I'm going to shelf my plans, right? And that's happened 2 or 3 times in the last decade. And I think where we are now is we're over that crest where, it doesn't really matter what Bitcoin does per se. I think the blockchain technology in general has gotten to the point where those same traditional financial firms are recognizing that it may not be that they're going to make all their money offering Bitcoin liquidity to their clients, although I think that'll still be a part of it, is that there are certain efficiencies to be gained by adopting blockchain technology. And it's an investment, but convergence, we were talking about what's left,
Yeah.
right? Crypto and finance come together as one thing.
Yes.
You're still going to have Bitcoin. You're still going to have, potentially a number of DeFi protocols that are allowed to pass revenue via fee switch or some buy and burn mechanics back to their token holders. And so I think there will be a firm cohort of native crypto applications with tokens where it's more than just a governance token, and those will live on. And then you'll have traditional assets coming on chain, and it's not necessarily because the trading is more efficient. It's because the middle office, the settlement, the back office is more efficient, i.e. fewer humans involved. Right?
Yeah.
So fewer out trades, fewer missed settlements. But what I don't think happens is necessarily this idea of atomic settlement. Like, that's great for DeFi, and that there will still be a big place for that in potentially peer-to-peer transfers. But I think at the institutional level, the need for atomic settlements kills transaction velocity, and therefore you'll still see some element of delay between transaction and settlement, but everything will be cheaper and it'll be more final. So I think in terms of where we end up, we probably end up with almost everything tokenized because it makes everything from fund admin to clearing and settlement easier. And where we are now in that cycle is people are tokenizing things. There's not a great deal of velocity to those things after they're tokenized. That's because of two things, right? One is there's no regulation around whether or not you can self-custody tokenized equities, for example.
Mm-hmm.
But also the custodians, the transfer agents, all those folks don't have the crypto infrastructure built yet. So there is a fairly massive investment right now in the more forward-looking traditional finance firms and investing in things like key management, custody, the idea of vaults, right?
Yeah.
So I think post convergence, you have three main pillars. One is what we think of as crypto today. The other is tokenized RWAs. And the third is stable coins and payments, which I think have demonstrated their product market fit. And that's why you see Visa, MasterCard, et cetera, investing heavily.
And the trading infrastructure scene will allow for every flavor of order books to exist for the foreseeable future.
Yeah,
so
I mean,
Hyperliquid exists in, coexists with Coinbase and coexists with the CME and everyone has no true winner of all these. Sort of.
I guess I would phrase it this way. First of all, it's impossible to predict. But first, I don't think NASDAQ and New York Stock Exchange go away.
Yeah. Well.
Right. But I also don't think that they need to fully re-architect their systems to do trading on chain. I think trading can still happen off chain, just the way it still happens like that way at Coinbase and Binance.
Yeah.
And it's all the settlement infrastructure below that becomes tokenized. And then you've got, even things like distributing dividends. It's all done via smart contract, corporate actions, stock splits, like very easy to programmatically do that in a tokenized world. So you just get a lot of efficiencies under the hood. But I trade Apple on the New York Stock Exchange and it still doesn't settle atomically. Like, at least that's the way I see things shaking out. I don't think you can move to a 100% sort of DeFi world.
And brokers have a seat at the table with this world becoming because centralized exchanges and even indexes, right? Like in crypto for the past, whatever, decade, right? They've proven the model of you're the matching engine, you're the settlement layer, you're the broker, you're everything. It's one counterparty. You go open an account on one of these exchanges and you can do whatever you want to do, right?
Yeah,
in TradFi, you can't touch the New York Stock Exchange, right? You gotta.
Yeah, I think, again, I don't know the answer. I suspect what will happen is the world of equities will be bifurcated between the so-called official tokenized version of Apple and the unofficial tokenized version of Apple. And the unofficial tokenized version of Apple will be probably in the SPV wrapper structure that we have today.
Mm-hmm.
And those SPV wrappers will get better in the sense that you'll get splits and you'll get a chance to participate in corporate actions, and you'll get dividends. But those SPVs, maybe, right? Because I'm sure there's probably some regulatory angle that I'm not contemplating, but they will give retail ex-US the ability to self-custody those assets, and that's really what the demand for those is. And DeFi and crypto has gotten ahead of the regulation and offered those services to people who are demanding them. And so I think we'll be in a bifurcated world for some time, where if you're a US retail participant, nothing will probably change in terms of how you
Access these markets,
acquire stock and access those markets. If you're somebody in a developing nation, you may well be able to self-custody, shares of US Mag 7 names.
Which I think is quite big for a lot of people, right? So I want to wrap it up with just to understand a little bit more, right? As you're running a business in one of the largest sort of shops within the financial markets, at least today, within the digital asset space and even beyond. What are you guys focused on over the next 12 months, 24 months?
Yeah, it's everything we've spoken about, right? I think if you think about how we're positioned, we're very good at crypto, and we're recognizing that crypto and finance become one thing. And, look, the founding purpose of our firm was to bridge traditional and crypto markets.
Yeah.
And so, that's meant different things over the years, right? Initially it was, we're just going to be professional and bring a level of professionalism and trust to crypto that may not have existed. Right now it means more concretely, we're trying to have a seat at the table in terms of how these systems get built for TradFi firms. We're trying to make sure that we can be involved. Part of our thesis is that we end up in this bifurcated world where you still have the wrapped version, you have the official version, and not every other financial intermediary is going to have the ability to go between both worlds from day one. So we're trying to make sure that we do, and we'll still be very good at trading Bitcoin.
All right.
Right. But, and last thing to say is, you've got that convergence thesis, but we also, given our, smaller footprint and our ability to move quickly, we also view ourselves as being at the vanguard in terms of what I'll call novel financial products. So that's why compute is something we talk about. That's why event contracts are something we talk about, right? So, we're not just a crypto firm, we are a novel financial product firm. And that's really that's what we spend all of our time talking about.
Trying to be on the frontier of where financial markets are heading, right?
Exactly.
Beautiful. Mike, thank you so much for joining us today.
Thanks for having me. It's been great.
This has been awesome. Thank you again.
Thanks so much.